There are literally thousands of exchange-traded funds, but how do you choose between one fund and another? I've created a checklist of 8 criteria which I use when I select a fund. The purpose of this is not just to help you make the choice, but to help you document that choice, because in a year's time you could easily forget why you chose that fund. Now this is really important, because if you want to sell the fund, you have the checklist in front of you and you can look through it item by item to see if the investment thesis has changed. If it hasn't, then don't trade. It's very important to trade as little as possible, because remember, that increases the cost of running your fund and it reduces your return. So let's go through that 8-point list in a bit more detail. Remember, this is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. The first thing to think about is the fund manager. Now, the importance of the fund manager depends on the type of fund. The fund manager is most important for an active fund, because the fund manager chooses which assets to buy and sell, and that generates the returns of the fund. There are 2 types of active fund. The first one is an absolute return fund, where the job of the fund manager is simply to generate as much return as possible whether markets move down or up. These tend to be the most expensive funds of all. Then we have active funds which are intended to beat a benchmark. So the benchmark would be an index like the FTSE 100. And the job of the fund manager is to generate returns which are better than the FTSE 100. They do this by going overweight some stocks and underweight other stocks versus the benchmark. These funds tend to be intermediate in terms of cost between active absolute return funds and passive funds. For passive funds, the fund manager is least important, because tracking a benchmark is a fairly mechanical process. It doesn't require stock selection skill, so it tends to be much cheaper than active funds. And passive funds have become extremely popular. So let's quickly look at examples of those 3 types of fund. Starting with the absolute return fund, there is no benchmark. And you can see that the fee is very high, 1.69% per year. And for these funds, you look very carefully at the managers. For this Schroder UK Dynamic Absolute Return Fund, the fund managers are Paul Marriage and John Warren. And you may well want to look at their history to see how well they've managed funds in the past, because the returns of this fund will be driven exclusively by their stock picking skills. This is an active benchmark fund because it has to beat the MSCI World Index. The fee is a little bit lower than the absolute return fund, only 1.05% per year. And the manager, Terry Smith and his team, intend to beat the MSCI World Index. And so far they've been very successful at doing just that. Finally, here's a passive fund. It's actually the largest ETF in the world. You can see that the management fee is extremely low, just 0.09% per year. And they don't even give a name for the management team, because it's almost irrelevant. What is relevant is the size of the fund. It's $260 billion at the moment. Size matters because you get an economy of scale. That's one of the reasons why the management fee is so low. And all this fund does is it tracks the movement of the S&P 500 index of US stocks. So what is this benchmark that we keep talking about? When you buy a fund, you should always look at the fact sheet, because that tells you the key attributes of the fund. And if it has a benchmark, it'll tell you what that benchmark is. So for this fund, you can see it's tracking the S&P 500. Whereas this fund is tracking UK govies, that's UK government bonds. And if it's a tracker fund, all I have to do is Google the name of the index. The S&P 500 is maintained by S&P Dow Jones Indices, and you can find out all about it from their website. And FTSE Russell manages that gilt index that we saw. So a benchmark is just one of these indices, and if you want to find out more, just go to the benchmark index provider. As for any investment, you have to think about risk. For comparison, I've shown you 2 funds here. One of them is VGov, which buys UK government bonds. Those are very safe investments. And I've contrasted that with VFEM, which tracks emerging market stocks, which are very risky in comparison. But what does that actually mean in terms of the daily price movements? You can see in cyan, the VFEM fund tends to move up and down a great deal. But over the long term, and here I'm talking about over decades, it'll increase in value more than the safe VGov fund, whose movements are much smaller by comparison. Of course, sometimes it rises and falls, but these tend to be much smaller rises and falls than for VFEM. So the idea is that riskier funds tend to move more than less risky funds, but in return, they potentially offer more upside. Here I've ranked the volatility or typical daily price move of various assets. The assets with lowest risk are at the top, and the assets with highest risk are at the bottom. And because the fund is just a pot of these assets, it'll pick up the volatility or the risk from the assets inside it. So here are 18 Vanguard funds ranked by their risk, and you can see the VGov fund, which we saw earlier, has a very low risk, a low typical daily price move, because it buys UK government bonds which are very, very safe. Whereas the VFEM fund at the bottom is the one that we saw moving around a great deal, and there the volatility is almost twice as much as for VGov. So when you buy a fund, you should be aware of this price risk, which you can infer from the daily price volatility. But there are risks other than price risk. Here's a junk bond fund from the United States called JNK. If you look at the fact sheet for JNK, one of the warnings is about liquidity. In other words, during a crisis or period of market stress, the shares of JNK will be easily tradable because they're like stocks. But the assets which JNK buys can't easily be sold because junk bonds can sometimes take a very long time to sell, particularly in a crisis. So during these periods of market stress, the fund may trade at a significant discount to the bonds themselves. So you have to consider the liquidity of the stuff which is inside the fund. Now if that's shares in developed markets, that's not a problem because they're very liquid. But if it's things like corporate bonds or emerging market stocks, you may have to consider these liquidity constraints, which may affect the value of your fund during a period of market stress. You can't just think about a fund in isolation, you have to think how it fits within your portfolio. Now a portfolio is very much like an ecosystem. It has to be kept in balance. You can't have too much of one species or another species. The portfolio will work best if you have a balanced portfolio which is globally diversified. So if you're thinking about buying a new fund, you have to think how it fits within the portfolio. Or if you're thinking of selling a fund, will it detract from the diversification and the balance of your portfolio? In other words, buying a fund is not like Imelda Marcos buying another pair of shoes. She never thought about it, she just kept on buying. And that's reflected in the views of Jack Bogle, founder of Vanguard and Davros lookalike. He actually recommends just holding two funds. One would be a stock market tracker for the US, and the other would be a bond market tracker for the US. And although that's very extreme, it's very good advice to keep your portfolio simple, and that means having as few funds as possible while still keeping that global diversification. You have to think about why you're buying the fund. Are you buying it for capital return? In other words, you buy at a low price, you sell at a higher price, and profit from the price differential. Or are you buying for income? Some funds have high dividend yield, so they provide a continuous stream of payments for holding the fund, as you receive a fraction of the profits generated by the companies in the fund. Or are you buying the fund for diversification? In other words, to reduce the global risk of the portfolio by dampening the volatility. But if you think in terms of these criteria, it'll make it clear why you're buying this fund. You have to think about how much a fund costs. Larry Bates is a Canadian ex-bond trader who's come up with this amazing thing called a T-Rex score. Now this looks at the effective fees over the long term, and there's a calculator on his website, wealthgame.ca, which allows you to calculate the effect of those fees. You tell it how much you're investing, how much annual return you expect on that investment, the fees on your investment, and the time you invest. The T-Rex score will tell you how much of the returns you actually keep. So let's look at the example which you can see here. We're assuming that the investment is generating 5% returns for 25 years. So the white magic of compounding means that over 25 years this will generate a whopping 239% return. Now the fee we're paying is 1.84%. That doesn't sound like much, but when you're only earning 5% per year, when we subtract that fee from the 5%, we end up with 3.16% return. Now the dark side of fees, you can think of that as the black magic of fees, means that instead of 239%, we now make only 118%. That means that half of our return has been paid in fees. So remember, fees compound just like returns. So a 1% fee can be highly significant when it's taken over a long period of time. And always aim to buy funds which have the lowest fees possible. For passive funds, size certainly matters. The reason for that is that funds have to be viable. In other words, they have to generate enough revenue for the fund manager for them to continue to exist. So say the size of the fund is £1 million. That sounds like a lot of money, but remember the fund manager is just making 1% of that, or £10,000 per year. That's not going to be enough to pay any employees at all, and it's not viable. £20 million, on the other hand, is just borderline. That'll generate about £200,000 per year if the fee's 1%. So if you see a fund has assets under management of £20 million or less, find out why. It may be because the fund is new, or it may be because the fund is about to cease to exist. The largest funds can manage over £1 billion, which is how they can afford to lower the asset management fee from 1%. And that's good for you because you're benefiting from the economies of scale. Something to be wary of is leverage. So first let's look at the good side of leverage. If I have a real money investor who has £100 to invest, they buy one stock for £100, then they sell that stock for £110 and they make £10 profit. But now let's consider a leveraged investor. They were very confident the price of the stock would increase. So not only did they invest the £100 which they had, they borrowed another £100 to invest as well. That meant they could buy two stocks for £100 and then they could sell those two stocks for £110 and they made £20 profit. But why stop there? They could have borrowed another £900 and made £100 profit. But you have to be careful because there's a dark side of leverage. Not only does it amplify your positive returns, it amplifies your negative returns or your losses. So if the stock price had crashed down to £40, the real money investor would have lost £60. But the leveraged investor would have lost £120. In other words, they'd have lost more than they initially had to invest. So leverage amplifies your gains and your losses, which means that it could be very dangerous if the market turns against you. You can buy funds which have leverage built inside them. So for example, the ProShares Ultra S&P 500 doesn't match the returns of the S&P 500, it doubles them. So say for example the S&P 500 goes up by 1%, this fund will go up by 2%, and a fall of 2% will be magnified to a fall of 4%. So your return as the fund holder will be twice the return of the benchmark. You can also have funds which are short the index. This is the ProShares Ultra Pro Short S&P 500 fund. And this returns minus 3 times the return of the S&P 500. So when the S&P 500 goes down, the price of this index goes up by 3 times as much. But again, you have to be very cautious about using leverage, and this is best left to the experts. The final item on my checklist is currency. If your fund buys foreign assets, then the price of the fund will depend on the exchange rate between sterling and the foreign market. As an example here, I've used the iShares MSCI Japan tracker, and I've shown two variants of the fund. The one on the left isn't currency hedged. In other words, it's fully exposed to the exchange rate risk of sterling versus the Japanese yen. On the right, you've got the hedged fund. In other words, it removes that currency risk because it contains derivatives which neutralize the price movements of the currency. Now the contents of the two funds are identical. 326 large Japanese stocks such as Toyota, Mitsubishi, SoftBank and Sony. An incidental difference is that the one on the left pays a cash dividend, in other words, an income. The one on the right is an accumulation fund. It reinvests any dividends directly back into the fund. They're not paid to you directly, but the price of the fund is boosted up by the dividend. Now you may have to pay a fee for the hedge. It's not a huge difference. You can see the hedged version is 0.64% per year, and the one on the left, the unhedged, is a little bit cheaper at 0.59% per year. I've shown the value of £100 invested in those two funds in 2014, and you can see that the hedged fund performs much better than the unhedged. Part of that is due to the dividend of the Japanese stocks. That's just over 1% per year. But the other part was the benefit of not being exposed to the currency risk. You can also see the effect of Brexit, which weakened the value of sterling versus the Japanese yen. What you can see is that the unhedged version of the fund benefited greatly from that devaluation, because the buying power of yen increased in sterling, and that increased the value of the fund, whereas the hedged version of the fund didn't benefit from that devaluation at all. But what you should be aware of is that if you buy a fund with foreign assets and it's not hedged, you will be exposed to that currency risk. It could go in your favour or it could go against you, but just be aware that it's there. So that's it. That's our 8-point checklist. If you want to download this, just go to our website and you can download the PDF for free. And if you want to learn about funds in more detail, why not book a power hour with Romin? Just go to PensionCraft.com and you'll see how to book the hour. It's really easy and I would love to hear from you. And if you want to see more of these videos, why not subscribe to our YouTube channel?